Forbes India presents D2C Disruptors Awards, powered by Smytten.
Welcome, panelists. Now, before we kick off this conversation, I want to do a really quick survey of this room. Raise your hands if you, your family, or your friends have ordered from Plum, MyGlam, any of these D2C beauty startups. If you've ordered food from Licious, Epigamia, if you bought clothes from slow fashion brands on Instagram, if you've perhaps ordered jewelry online, please raise your hands, everyone. Rajan Anshul. You've ordered? You've ordered? Okay. So I don't see one person who hasn't raised his hand. And, clearly we're all active participants in this India's D2C boom. And I'm not surprised that the D2C business model is poised to create, reports suggest that over $100 billion market opportunity by 2025. So let's understand what makes this model click from our panelists here. Rajan, let me start with you. We all know that the D2C market is among the most booming subsector in the e-commerce industry. So let me just address the elephant in the room. What makes Rajan Anandan bet big on a D2C startup? What piques your interest?
Yeah, firstly, thanks for having us. And thanks to the Forbes team, the Smytten team, and thanks for moderating. Look, so we at Sequoia Capital, we've now got a pretty significant portfolio of brand. By the way, D2C, I think, is sort of from 2-3 years ago. Okay. The new term is called NCB.
And what is that?
New consumer brands.
Okay.
Right?
It's quite a new term.
Because the reality is, you launch a brand, whether you sell directly to a customer on your website or your app, or whether you sell on Amazon, Flipkart, or Nykaa, or Smytten, or whether you go offline, doesn't really matter. But we know one thing. If you're going to get to 500 crores of revenue, you're doing all of those things.
Absolutely.
Right? So that's why I think the whole D2C is sort of an interesting way possibly to get started, although maybe you're better off starting just on Amazon and Flipkart and then building your own site. So anyway, that's just as a side. So as at Sequoia, look, we've invested in late-stage companies like Mamaearth. We have many early-stage companies across categories, mostly beauty and personal care, but we have toys, we have drinking water, purifiers. We actually, in our next Surge cohort, you'll see some very interesting companies in other spaces. But fundamentally, what do we look for, right? If you're early stage, we try to make sure that the team that's building this company has the set of skills to actually build a large new consumer brand.
Okay.
And an important part of that is unique insight into the customer segment that you're trying to serve, as well as the specific customer need that you're trying to serve, right? Because today, given sort of the reach of e-commerce, it's not that hard to launch a new brand and get it to a few crores a month of revenue. But if you really want to build a large company, you've got to have a unique insight into a problem and a customer segment. We're also, if a product is launched, even at the very early stages, we want to see something like in other spaces, like software, we're okay to invest in a company that's pre-launch. But I'd say in new consumer brands, we want to see a little bit of traction. We're trying to understand, is there real product differentiation?
Okay.
Right? What's really unique about this product? And the last thing I would say is, especially if you, even if you've got 1 crore a month of revenue, if you can't really have very strong unit economics,
absolutely,
that sort of tells us that maybe the product isn't that differentiated, right? So we see a lot of consumer brands, because the reality is you spend a bunch of money on marketing. I see my dear friends from Google here, whether it's Google or Facebook or Amazon or any one of these companies. The reality is today, right? You can actually spend money on marketing and you can get revenue.
Absolutely, yeah.
But that doesn't mean you built something very, very special. By the way, Google is a great platform. Before you get very upset. So that's what we look for.
Okay, so before I get to Anshul, one quick question. We were talking earlier and you told me that you're in talks with a Cashew brand and you just spoke about the things that you look for in a D2C brand. I'm curious to know the kind of opportunity you see in the cashew market. And
yeah, let's ask the audience a question. How big is domestic consumption of cashew nuts? No, you can't. You probably no. How many? No. Domestic consumption in crores. The domestic market for cashew nuts. You eat 50 cashew nuts a day. Is that your answer? Oh my gosh, that's a lot of cashews. Okay. 1,000 crores. Other guesses? How big is the domestic market for cashew nuts? Any guesses? It's 16,000 crores.
16,000
16,000 crores. And we met about a month ago, we met this new consumer brand. It's an NCB, not a D2C.
Yeah.
A new consumer brand that launched 2 years ago. They had 160 crores of revenue run rate. They're EBITDA positive. And you know what their 3-year plan is? Get to 1,000 crores and list. Their ARPUs are too low to be selling on Amazon or selling on their own site. They sell cashew nuts, right? So I think basically in India, across every segment, you have this extraordinary opportunity to innovate, right? But you have to have unique insight. I mean, cashew nuts is an unbranded market, right?
Absolutely.
Like you eat 50, I probably eat 100 a day. I mean, I love cashew nuts.
Yeah.
Like I would like every day order cashew nuts. So yeah, I mean, but that's super cool.
Okay, super cool. Anshul, I want to ask you, you've invested in some notable D2C or NCB brands, like he calls it. How do you perceive D2C startups when you're investing, and what has changed,
So look, for us, brand investments have been almost a 15-year-long journey before this term even came into picture. And at that point in time, the terms that was used was, how affiliated the consumer is, what is the experience consumer is getting, and are you making the consumer come back to you, right? So for example, a Fab India, in which we are investors, they have their own stores, and consumer would walk in because they find the products very, very unique, the proposition that is there in terms of pricing, basically those were the things that a Fab India could offer. And,
sure.
and I think that is the philosophy we have applied across our product portfolio. Now, of course, 6-7 years ago, when India started to see a lot more happening on the digital infrastructure, is when you saw consumers also moving in that journey. You're off initially to begin with a very millennial customer who was comfortable buying online, and then of course COVID accelerated that process for basically everyone. And that is where our consumer brands, whether it's a Duraflex mattress or even a BKG Foods, for example, started to come online because this is one of the very important means to reach the consumer and just expand in terms of where you are, where you have your presence, right? So for us, D2C is effectively, are you a brand which is able to talk to its consumer, whether it's through an online channel or an offline channel, whether it's your own store or through your brand website, effectively that. And then on back of that, like Rajan said, right, I mean, economics is very, very important to us. It has always been important, even before the term became very fashionable.
Okay, all right. I wanted to speak about how we all know that the pandemic caused this sector to really boom. Everybody went online. In fact, Meta's Mark Zuckerberg recently admitted that he actually, revenues were hit because he overestimated the power of the pandemic's e-commerce boom. And perhaps he made some investments that did not, clearly weren't good enough later, when people started going to physical stores. Rajan, are we seeing sales plateauing because people have now actually started going to physical stores? Are we now seeing normalization, which was pre-pandemic? What conversations are you having?
Firstly, I mean, you know a lot more about Facebook and Mark Zuckerberg, but he spent $9 billion trying to create the metaverse.
Yes.
$3 billion a quarter, and then revenue slowed. If revenue had slowed, he hadn't increased costs, I think maybe Facebook would be in a slightly better place. But look, I think in India, what we are seeing is continued growth in e-commerce, right? It's about a 60 or 70 billion GMV market. It was growing at 40-50% during the COVID period. Now it's growing at, probably 20-25%. So e-commerce continues to grow, but the reality is offline has come back strong, right? The simple way we think about any NCB, this is as of like 3 hours ago. 2 hours ago when I saw you. NCB is the new term, okay? A new consumer brand is, let's say you launch it online, you can maybe get to 50, 100, 200 crores. We think 200-300 crores is probably tops. Beyond that, you absolutely have to go offline. In fact, going offline gives you much better moats than selling online, right? Yes. Like the reality is if you're selling on Amazon, every other competitor can sell on Amazon as long as you've got pretty good digital skills and you can manage sort of the Amazon system, but going offline is much harder. So what we are trying to get all our companies to do, right? We have now over a dozen consumer brands that we've invested in, from the very late stage companies like Mama to very early stage companies like Nat Habit and Minimalist and so on and so forth, right? Across beauty, but across other categories also. What we are trying to get our companies to do from very early stages, right? Even before they get 40 to 50 crores. Once you start approaching 40 to 50 crores of annualized run rate, so call it 3-4 crores a month, start building offline capabilities, right? Because number one, it's a very difficult skill to build, and number two, if you get it right, that can scale for a very long period of time. Now, you won't triple and quadruple every year, but you can grow 100% a year for many years, right, with offline. So I would say, it's not one or the other. That's what I said, right? I think this era of we're only going to be a digital brand, we're only going to be a digital first brand, these are all very old ideas.
That's not going to work.
Yeah. No, it's just they're old ideas, right? I mean, what you want to do is you want to build an extraordinary new brand. Over time, it becomes an extraordinary family of new brands. And then you're going to be omnichannel. So, like Smytten, right? When you're launching, it's a great platform to do your sampling, right? Or when you want to get early traction. Let's say even before you launch a new brand, right? You should go figure out like, okay, is this thing going to work or not on Smytten? And then you can start scaling or sampling. So that's a really good channel. Should you sell on Amazon? Absolutely. Flipkart? Absolutely. Nykaa? Absolutely. Should you be offline? You bet.
Okay.
Because if you're going to beat 1,000, 2,000, 5,000, 10,000, 20,000 crores of revenue, you are not going to do it online. So you got to do pretty much everything.
So omnichannel is the go-to market strategy for pretty much all the brands, and digital first is old now. And can you talk to us about the omnichannel strategy that is so important today that Rajan was also talking about? And most essentially because everybody is saying Bharat is the next big opportunity. I've been speaking to a lot of D2C brands where they tell me that actually 50% of their market share is from tier 2, tier 3 towns, some as high as 70%. So the omnichannel strategy, how is it going to work, especially to tap into this massive opportunity?
Yeah, so look, from our portfolio perspective, if I look back and reflect, the journey started the other way, right? Most of these brands were offline and then they went to online to acquire those customers. Even in a case like Nykaa, where, we had invested, the journey started as an online platform, but they went about opening their stores. And look, what we heard was that in each of these cases, wherever the price point was sort of suitable, of course, even today, if you talk about somebody going and buying a 50,000 rupees lehenga online, that's not happening.
Yes.
Okay, people are wanting, online I meant. That's not happening. For those things, still the touch and feel works. For rest, the model is pretty omni. Whether you talk about a personal care where initially possibly people do want to try out in a combination of online and offline, and then replenishment can pretty much happen online, right? Or even apparel brands, once you have built a certain trust through either an online and offline touch, then next purchase can definitely be online. So I think it is that mix of where you are in that journey. If you are in the initial journey where trust has to be built in, possibly an offline would work. The second thing is, whether you look at from a penetration perspective, while online has come a long way in terms of the overall size and the growth journey is very, very high. From a penetration perspective, we are still talking about less than 20%, right? Look at any category. And that is why offline becomes such an important part. And you are right, we are seeing this across the brands that the tier 2, tier 3, where possibly a lot of brands do not have their physical presence, they are coming to these online platforms and saying, I want to use the same brand that a consumer in a metro city is accessing. And I'll give you a personal example, right? I come from Patna, and today the family I have behind, they don't have an access to a Bobby Brown store, for example, right? So to that extent, the consumer there is fueling the whole purchase which is happening online because the access is there.
Yeah, they are well off, but they're starved of brands.
Absolutely.
Okay, one of the reasons for the boom of the D2C industry has also been the ease of setting up online stores. We've got enablers through the support of, you've got startups who are doing logistics for them, you've got startups for payment gateways. How do you view the entire landscape? How has the whole D2C brand ecosystem evolved, Rajan? How has the game changed?
I mean, it didn't exist, 6-7 years ago, right?
Yeah.
So, I mean, the single biggest enabler, it was the development of these e-commerce platforms, right? So today we're at about 5 lakh crores of GMV. In 4 years, it'll be 10 lakh crore of GMV, right? Today, about 125 million Indians buy products, about 350 million Indians actually, buy digital goods using digital payments. This 125 million Indians buying products, that number is going to go to about 300 million over the next 5 or 6 years, right? So I want to, so first big thing was e-commerce platforms, right? So because once you start buying online, let's say on an Amazon or a Flipkart or Nykaa, then you're much very comfortable buying on a, let's say, an individual brand site, right? Then you're much more comfortable. Let's say you find the Smytten app and you start trialing products, which is like, wow, this is like super cool or whatever. So I think that has really been the single biggest driver. I think the second thing which our ecosystem has done very well is innovated, right? Look, the reality is, Indian consumers who are in their 20s and 30s, I see many of them in this room, they don't want to buy like the traditional brands, right? They're just not interested, right? So if you deeply understand these consumers and you build products that are truly innovative, that meet these needs that they have, like Atomberg, which we didn't invest in, is a super interesting company. Like, who would have said you could reimagine the fan industry?
Absolutely.
There was insight about what changes can you make to the fans, right? You look at Boat. I mean, if you had said, look, some Indian company is going to come and compete with the Chinese to make headphones and electronic accessories, I would have said 5 years ago, no chance. How do you compete with the Chinese? Well, the reality is, not that they compete, they're winning big time, right? Because of this. So that's the second thing that happened, I think, was Indian entrepreneurs started deeply understanding these users and start building products. I think the third thing that has really happened is the manufacturing, supply chain, logistics, payment ecosystem, all that has fallen in place, right? In fact, I was talking to a founder who's here, who was recently in the US and said, it's so much easier to get up and running as a new consumer brand in India today than possibly any other place in the world, maybe except China. I don't know about what it's like in China lately. So all of this sort of has fallen in place, right? And what this really means is if you, let's say, want to launch a new brand, you're looking at basically a total TAM today of 5 lakh crores. Okay? In 4 years, this gets to 10 lakh crores. So if you can't really get to 50 to 100 crores pretty quickly with strong unit economics, you either don't have a great idea or you just don't know how to execute. Right? So in many ways today, my view is, every consumer brand, every new consumer brand should get to 50, 100, 200 crores. But to go beyond that is when you're going to have to, be omnichannel and do all these other things. But today, I mean, look, this is basically the entire ecosystem is now built. There's only one thing left, and that's called GDP per capita. India's GDP per capita is $2,000. But even on that, I don't know how many of you saw the Morgan Stanley report from this morning on India, right? India's GDP per capita is 3.5 trillion. It's going to get to 7 trillion by the end of the decade. India's consumption, right? Consumers spend about $2 trillion today. That's the number. That 2 trillion is going to go to 5 trillion by the end of the decade, okay? So all of you building companies, please keep that in mind. $3 trillion per year of consumption by Indian consumers. Hey, if you can't build 1,000 crore brand, when you have $3 trillion of incremental spend by Indian consumers, you probably don't have a great idea or you can't execute. So I think the time is absolutely now to build extraordinary brands.
Okay, the time is absolutely right. But Anshul, the boom has made D2C players very bold. They've become very fast, very aggressive in their growth targets, be it online, offline, their omni-channel strategies. But investors at the same time have become cautious. The focus is no longer on growth only. The focus is on unit economics. The focus is on profitability. Again, what conversations are you having with your companies? What are you telling them at this point in time?
So look, the conversation is not new. I think every idea has to be, or the delivery that you are making to the consumer has to be based on a certain inherent economics, because business ultimately have to make profit, right, in the longer run. So to that extent, as early on as entrepreneurs can figure out what is that unit economics which is going to be sustainable to create the long-lasting business is what, is the conversation we have always had, especially as a growth investor, right? Because, at any price, of course, anybody can deliver the growth. But the question is, can you do that at the right economics, right? And I think there are, few things to be looked at, right? No matter what scale you are at, whether you are at 100 or at 1,000, it's not a significant delta you're getting on your gross margins, right? So initially itself, are you setting the pricing right, in terms of the gross margins? Are you setting, in terms of the other costs, are you looking at them in the right way, saying, okay, here is my customer acquisition cost, but then going forward, I definitely basis the offering that my product is making, the customer is going to come back to me. Because if you have to go on acquiring that customer again and again, you will not make money, right? So that is another building block. Then, of course, as you get onto your omni journey, are you looking at what you're giving in the market very closely? It is, anybody can give a 6-month credit in the market and say, yes, I'm getting the growth. But truly, is it the growth, right? So those are just indicative metrics that founders should look at from the beginning itself, whether it's, on the online side or the offline side, and then say, truly I'm building this sustainable brand.
All right.
Yeah, I just want to add to that, like, this is something that a lot of entrepreneurs miss. If your mathematics of your business don't work at 50 lakhs a month of revenue, they are not going to work at 5 crores a month, and they're certainly not going to work at 50 crores a month of revenue. So when you get started, build your business so your math works, right? What does a math work mean? After marketing, CM2 or CM3 or however you define your business, if you lose money on every order, I mean, like, how does your business work? And by the way, if it's scale, it just doesn't work. That's not the kind of business you're in. Because you know why? Because you're building products. You're not selling software. With software, you have 95% gross margin. And even if you have 60% gross margin or 70% gross margin, it doesn't work. So actually, even at our stage, where we invest very, very early, we would look at a business and say, look, at 50 lakhs a month or 75 lakhs a month, despite having 60 or 70% gross margin, this business runs at negative CM2. Look, my 10-year-old, I don't have one, but if I had one, she could figure out how to grow a business while losing money on every order. Because all you do is you just crank up marketing.
Yeah, absolutely. In fact, I was talking to Kanwal Rekhi the other day, and he told me that, I found one company, I cannot name that company, but they turned profitable in the 11th round of funding. He told me, if you aren't profitable in your 3 to 4 rounds of funding, you're doing something wrong. It cannot be, just raising funds and not turning profitable.
And this is not profitable, right? This is positive unit economics. It's very different. We're not saying, look, companies absolutely should invest for growth for 4, 5, 6, 7 years, but you can't be losing money on every order.
Okay.
That era is long gone.
Absolutely. On that note, I'll open the floor quickly for audience, but we have time only for 2, 3 questions. If you could kindly raise your hands. Ravinder, I know you have a question. He's Ravinder from Roots Ventures. Who do you want to ask? Rajan or Anshul? Okay.
Root Ventures should ask her the question.
Yeah, hi, this is Ravinder. Either of you can take the question. I just wanted to get your views on the shift from, let's say, unorganized to organized industry, because, one interesting statistic which I just read is while one talks about D2C and how they are eating into the market share, coming into tier 3, tier 4 towns as well. But at the same time, HUL today, in the last decade, HUL has still by far the highest market share that they ever had in the last decade. So what explains this dichotomy, right? While you're talking about D2C eating into established markets, or let's say established market players, but at the same time, HUL's market share is also growing.
You want to take some? I think he's saying, despite all these new brands, HUL continues to gain share. So the largest player continues to gain share.
Yeah, sure. Look, I mean, HUL has actually done fabulous. If you look at the journey of HUL, they talk about 2 things. One is they are saying that, in terms of various categories, they are going to the premiumization route. So you start from a Rin as a consumer, go back 20 years where Nirma and Rin used to be a huge market, to Surf Excel and then coming to Surf Excel Matic. So they have done a fabulous job of taking the consumer through a journey where they are consuming more premium product for various benefits that they get. And the second one is really in terms of, using the whole technology as the backbone, whether it's on the sales side where you launch the product, get on, in terms of reaching the consumer digitally, or at the back end on the cost side, whether it's the whole supply chain part or reaching to the whole distribution in the tier 2, tier 3 cities as well, very, very efficiently. So they have used technology very efficiently to be able to deliver on both fronts, sales and cost side. I think those are some of the things which, I take back when I look at HUL's 10-year journey.
Yeah, and also I think, look, basically HUL is obviously an extraordinarily well-run company, as we know, and they'll continue to gain share. But keep in mind, they're at $70 or $80 billion of market cap. India is going to add $3.5 trillion of consumption over the next 7, 8 years. Can India create, I don't know, half a dozen $10 billion cap new companies? You bet, right? And so does that mean HUL won't go from 70 or $80 billion cap to 200 or 300 billion cap? Absolutely not. They will, because they're very well run. I think India is so large. I mean, like, this cashew nut example to me is fascinating. 16,000 crores.
I want to know the name of the company, Rajan.
No, that I can't tell you, no, because she'll go and invest in.
Oh, okay.
You know, so
Competition right here.
16,000 crores. It's a cashew nut market, completely unorganized, completely unbranded. New company, 2 years, goes to 160 crores of revenue. And it's completely offline and it's profitable. Yeah. I mean, it's crazy. No, actually, they don't want to raise money. That's the issue, you know? Oh. That's why I don't want to give it to them.
But that's also good. That's bad for you, but that's good for them that they don't want to raise money.
But it's amazing, you know? It's just, I mean, it's like the miracle of India.
Absolutely. Any other question? We're completely running out of time. One more question. Quickly, sir.
Hi, my name is Sajan. My question is for Rajan. Rajan, I heard you, and I think I was quite amazed by the fact that you presented. You spoke about startups getting into omni-channel strategy, which is critical for them. They can't sustain on just one strategy, whether it is offline or online. So amongst all of this, and you also spoke about the opportunities which the startups or the founders have today, right? But also the challenges. Now, amongst all of this that is happening in this world, we have been reading about the funding winters which has already set in. Startups are coming. Most of them are today literally getting challenged as to how will they sustain. Now, what is more important for any founder, especially, let's say, if it's just about, let's say, started 1 year or 2 years? Is it the ability to sustain, or is it the ambition to expand? What he should focus on more? That's my only question.
I think it's a great question. Look, I'll just simply say this. You can't win if you're dead. You know, like, if you're dead, you can't win, no? If you're dead, you're not even in the race. So I think priorities has to be, you have to survive. You know, what's very interesting is, you know, every startup is in this big hurry to build a huge company quickly, right? The reality is it takes 10, 15, 20 years to build an enduring company. We've done the research, okay? On average, a really successful company has had at least 5 near-death moments. You run out of cash. Your competitor launches with 100x more funding. Your co-founder leaves. Your 3 largest competitors launch like $100 million lawsuit against you, and you have 52K in your bank. Okay? These are all near-death moments. So the reality is, you know, you've got to stay in the game. If you're not in the game, it doesn't matter, because then you're not in the game. Now, that being said, you should make sure, especially if you're an early stage company, that you have what we call extraordinary product market fit, right? Your customers really love your product. They continue to buy your product, and you make money making and selling your product. And this is where contribution margin negative businesses are actually not that great, because to me, what it shows, when you have CM2 negative, it shows just one thing. You don't have PMF. You're just basically marketing your way to growth, right? So if you're an early stage company, now if you don't have those 3 things, you may be better off saying, you know what, let me just go do something else, right? Because what you don't want to do is, see, staying alive to build a mediocre company is even worse than being dead. I don't mean literally dead, but your company, right? Because you don't, if you're going to spend 10 or 15 or 20 years, you do not want to end up with a mediocre company. You want to build an extraordinary company.
All right. Before I let you guys go, we wrap up this conversation. One last question, and I was about to ask the both of you one breakout company for 2023, but you're going to name your portfolio companies, so I'm not going to do that. But one dream company, one dream D2C company that you'll be like, when you see them, when you hear them, you're going to be like, here's the check. You're going to be the next breakout from the D2C space. Who wants to go first? Okay.
You go first.
Yeah, look, I mean, I think that's like saying, show me a great technology company. You know, I mean, like, I'll tell you when I see it. But what do we look for, right? Like, I'd love to see new ideas. Like, we have an investment in a water purification subscription company. They have 100,000 homes. It's called Drink Prime in Bangalore. Okay. It's super cool. Why would you go spend 15,000 rupees to buy a water purifier when you can get this IoT connected device? It's super cool design. You can pay 500 rupees a month. If you don't like it, you can give it back, right? So you know, what we'd love to see is companies that are taking large categories and reimagining them, right? With unique insight about that user in that category and building it. So it's not a specific, like, until I met the cashew nut company, I had no idea about cashew nuts. I was like, whoa! The whole meeting, I was like, whoa! Like, whoa. The whole meeting was like a whoa meeting.
Rajan, you better invest in this company next week. We all are curious to know the name. And all the investors right here, I'm sure they're all Googling.
No, I think all the investors know the cashew nut category. Now they're all going to chase the cashew nut category. Okay,
all right. Anshul, your thoughts?
Yeah, look, I mean, you know, we always look for that company which can do a lot on the product innovation, because ultimately we as investors are not capable of developing that unique product, right? So for me, rest everything you can help on, you can build, there is ecosystem there. So that unique product, and I think Rajan took a great example, and I'm a big admirer of how Atomberg came in a very competitive market, very crowded market, full of brands, and just with that product innovation they could do, they created a space and a big name for themselves, right? And the love from consumers. That is admirable.
All right. With that, it's a wrap on this panel. Many thanks, the both of you, for joining us. It was an absolute pleasure talking to the both of you. Thank you all for being such a fabulous audience.
Forbes India presents D2C Disruptors Awards, powered by Smytten.